Most financial independence investment strategies focus solely on equities or primarily on stocks. But so many times, people often miss the importance that bonds actually play in your portfolio, even while you are financially independent, even when you're on the path to financial independence. And that's why today in this video, we are going to discuss the essential role that bonds play in your financial independence portfolio. But before we do that, we need to just real quick recap on what bonds are. So bonds, just really quick in layman's terms, bonds represent a loan made from an investor to another entity. That other entity can be a corporation, it can be a government, it can be the federal government, it can be pretty much any other kind of entity. That is why bonds are known as debt investments. Basically, someone owes you money because you gave them money. And it's also important to know how bonds work. So just on the surface level, so an investor will loan money, that entity will pay interest, and that interest is known as the coupon rate. So whatever the interest rate is, that is known as the coupon rate on that bond. And then after that bond matures, which means the length of the bond, it comes to an end. So if that bond was 10 years, at the end of that 10 years, that entity is then going to pay back the principal of the loan. So the principal of that bond. So if you paid $1,000 to that entity, at the end of 10 years, it's going to pay that $1,000 back to you. And during that 10-year time period, it's going to be paying its coupon rate. So if that, let's say that coupon rate was 10%, then 10% of $1,000 is going to pay $100 to you every year in the form of interest. And then that's going to occur for over that 10-year time period. And then at the end of that time period, you get the $1,000 back. That is basically on surface level how a bond works. Now, when it comes to financial independence, it's important to know how those bonds are going to play an important role in your portfolio. And also what kind of bonds you should have in your portfolio, because not all bonds are created equal. You can have bonds that are super safe that pay very little interest, say a bond held by the federal government in the United States, or you can have a bond that pays a high amount of interest and that is actually relatively risky, say what's known as a junk bond, to a corporation that isn't good at paying its debts. But for the sake of a financial independence portfolio, I think the best reason, and pretty much for most individual investors, what's going to be best is just to stick with a total US bond index fund. Okay, so if you stick with one of those and that represents all the bonds in your portfolio, you just need one fund and it's going to take care of you. It's going to represent everything, because what that total bond index fund seeks to represent is pretty much the entire US bond industry within the United States. So if you just stick with having one of those in your portfolio, I think you're going to be good most of the time. A really popular index, a bond index that follows that is known as the Barclays Aggregate US Bond Index. So if you find an index fund that tracks that index, you're probably going to be good to go. Because if you were not using just say that index fund, if you're actually trying to pick out different kinds of bonds to use, you need to know the difference between their returns and their volatility, because it's just like a stock. Typically, the more volatile it's going to be, the more risky it's going to be, the more it's going to pay, and vice versa. The less volatile, the less risky it's going to be, the less amount of interest that you're going to get from that bond. So like I said before, a government bond might pay a lot less interest, but it also might be a lot less risky. Whereas a corporate bond is probably going to pay a little bit more interest, but it might be more risky depending on what kind of corporation, big, small. If the corporation has, a good credit rating, all that kind of stuff. So it's going to depend, and that's why I think that the total bond fund is pretty much going to cover everyone in the financial independence community in most circumstances, especially for individual investors. Now, before I move on to one of the most important things, which is the role of the bonds in the financial independence portfolio, I just want to say really quick, if you're liking this video so far, please make sure you like it and give it a thumbs up. It really does help me out. I really do appreciate it. And make sure you subscribe to the channel and put on that bell for notifications, because every single week I'm putting out new information and new videos on personal finance, and I just know that there's something I can help you with. Right now, I'm putting out new videos every Tuesdays and Fridays at 8 a.m. Pacific Standard Time, so make sure you are subscribed and you have that bell on so you don't miss those new videos. Now let's move on to the role of bonds in a financial independence portfolio. Well, one of the main reasons why you should have bonds in your portfolio is to reduce your volatility. Now, if you're super young and you're just starting your path to financial independence and you know your risk tolerance, then maybe you don't really need bonds at all, or very, very little bonds in your portfolio. Okay, because if you can take the volatility of having, primarily equities or primarily stocks within your portfolio, then go right ahead, because most likely you're probably going to return a much higher return by taking on that risk and taking on that volatility than if you were to have a bond-heavy portfolio. So if you need to reduce the volatility in your portfolio, then you should definitely have more bonds in your portfolio. And that's just going to depend on your individual risk tolerance. but everyone should probably have some kind of cushion within their portfolio to reduce their volatility. Especially it gets important as you're nearing closer and closer to financial independence and you become closer and closer to actually withdrawing funds from your investments. And one of the biggest reasons for that is what's known as the sequence of return risk. So in a nutshell, in layman's terms, the sequence of return risk basically says that the most volatile and the riskiest part of your retirement or of your financial independence while you're withdrawing from your assets is about the first 10 years of which you're withdrawing from your portfolio. If you were to unfortunately have very drastic drops within the stock market, and your portfolio value was depressed a lot, then that would be very unfortunate, and that might negatively affect the future of your portfolio because you were making withdrawals on a very depressed portfolio where the value was significantly down. So those first 10 years are really important while you are withdrawing from your portfolio. And having more money invested in bonds as compared to stocks and maybe just leveling off later might be a really good way for you to reduce that sequence of return risk, because typically bonds are not going to be as volatile overall as stocks will. Even if like a corporate bond follows along with a stock, reducing in a market downturn, it's not going to, typically speaking, it's not going to fall as much in value as a equity would, even if it was from the same company. So in order to reduce that volatility, in order to reduce the risk of the sequence of return, you should probably have some kind of bonds in your portfolio during those first 10 years because those are especially important. And you can definitely taper off later on. So let's say you start your financial independence journey and you start withdrawing from your portfolio. You might want to start with, say, just off the top of my head, 30% bonds and 70% stocks, right? And then over that course of that 10 years, maybe you want to reduce the amount of bonds you have in your portfolio, perhaps by 1% per year. So at the end of 10 years, you'll end up with an 80-20 split of 80% equities and 20% bonds. And maybe that would be good for the rest of your financial independence journey. But in order to reduce that sequence of return risk, you might want to have more bonds, at least initially when you start withdrawing from your portfolio, because those first about 10 years are the riskiest. And just to dive a little bit more deep on how much bonds you need in your portfolio, again, it's going to depend on your individual risk tolerance. Now, on the path to financial independence, when you're in the accumulation phase, as they call it, when you're just putting money into your investments, it's not really important to have that much of your portfolio in bonds per se, unless of course you can't take the drastic fluctuations within the stock market. So you can afford to have a lot less bonds when you're on the path to financial independence. But once you become financially independent and you actually start withdrawing from your portfolio, maybe you want to have a higher amount of bonds, maybe just to shave off some of that risk of market volatility, and especially during those first 10 years during the sequence of return risk. Because at the end of the day, what it comes down to is you want to have a successful retirement. You want to, yes, grow your portfolio, but you also don't want to lose your portfolio while you're actually withdrawing from it. So the best amount of bonds that you can have in your FI portfolio is the right amount to let you sleep at night, to where you keep with your financial independence plans, and to where you don't run out of money. And so while bonds are definitely a really important thing to have in your portfolio during financial independence, there's so much more to learn about financial independence. And if you haven't already, you need to watch this video that I created called How to Achieve Financial Independence in 10 Years or Less, because it's the complete guide, the complete blueprint to becoming financially independent. Thank you so much for watching this video. I'm Zach from OnCashflow.com, and I hope to see you next time.